The Washington Estate Tax: What You Don't Know Could Cost Your Estate by Tony Hinson. When most of us think about the estate tax, if we think about it at all, we are usually thinking about the federal estate tax collected by the IRS. And we may have heard from a friend or our accountant or our lawyer that the current federal exemption is huge, over $12 million per person. It is actually currently $12,060,000 per person, adjusted annually for inflation. So, short of hitting the lottery, we figure we really don't need to worry about such things. Unfortunately, one of the costs of living in our beautiful state is that Washington actually has a separate standalone estate tax with a much lower threshold for taxation. The current Washington exemption is $2,193, meaning that estates above that amount, which do not pass to a spouse or to charity, are subject to Washington estate tax. Thankfully, while the federal tax is a 40% tax on the amount over the exemption, the Washington tax starts at 10% and gradually works its way up to 20%. What counts for Washington estate tax purposes? Many people are under the erroneous assumption that only the probate estate is subject to estate tax. In general terms, everything that is part of your estate for federal estate tax purposes is also part of your estate for Washington purposes and is comprised essentially of everything you control. So, in addition to real estate, personal property, bank accounts, and similar assets, which we all understand are within our control, the taxable estate for estate tax purposes also pulls in many assets we wouldn't otherwise consider, such as life insurance death benefits, individual retirement accounts, 401ks, joint tenancy assets, pay on death accounts, assets held in a revocable living trust, and other similar assets which are not necessarily part of our probate estate. Are there differences between the federal tax and the Washington tax? Thankfully, yes. Gifting, while the federal estate and gift tax includes large lifetime gifts, currently those gifts over 16,000 per person in any one year, there is no Washington gift tax. This means that with a few exemptions, even large gifts are not included in your estate for Washington purposes. When combined with the currently enormous federal exemption, this provides an opportunity for Washington planning for folks with an estate which may be over the Washington exemption but under the federal exemption. Simply make one or more larger gifts to move their estate under the Washington tax threshold. It's a bit more complicated than that, but the absence of a Washington gift tax does provide excellent planning opportunities. Timber/business deductions. In addition, the Washington estate tax has exemptions and deductions applicable to timberlands/farmland and small businesses which are not available under the federal tax structure. There are specific tests and standards to qualify for these exemptions and deductions, but generally, timber holdings and small businesses enjoy greater protections under the Washington estate tax than under the federal system. Out of state property. While the federal estate tax applies to a descendant's estate regardless of which state the assets are held within, the Washington estate tax applies specifically to assets with a situs in Washington. Generally, this means that out of state real property, land, and other tangible assets located out of state are exempted from Washington's taxation, though in a complex calculation approach They are included to determine if the estate must file a return. Intangible property, cash, stocks, bonds, closely held business interests, and similar assets are generally considered to be located wherever the descendant/owner resided. Portability. Unfortunately, this is not an advantage under the Washington estate tax, but rather a trap for the unwary. Under the federal estate tax, a surviving spouse may port the unused credit of a deceased spouse with them to use for lifetime gifting or to cover their estate at their passing. This means that a surviving spouse may have an available credit of well over $24 million if they elect portability at the first spouse's passing. This is done by filing a federal estate tax return in a timely manner upon the first spouse's death, even if the estate is otherwise well under the $12 million threshold. Regrettably, there is no such availability for the Washington credit. If the spouses have an estate plan under which everything passes to the survivor, the marital deduction applies at the first death, and the opportunity to use the $2,193,000 Washington credit is lost. So while the federal tax allows their survivor to take the credit with them, Washington is a use it or lose it state for such purposes. Hopefully, this article will encourage those people with potentially taxable estates for Washington estate tax purposes to seek the advice and counsel of qualified tax planning professionals, such as an attorney, CPA, financial planner, or ideally a team of all of these to best advise the person on how to plan to minimize both federal and Washington estate taxes. This is certainly not an area where you want to go it alone. In most cases, a well-drafted plan with federal taxes in mind will provide a good beginning framework for Washington planning. But at the end of the day, it is important to have a team in place with an in-depth knowledge of both Washington and federal estate taxation.